How credit scores work. At some point in life, most people discover that a three-digit number quietly follows many of their financial decisions. Apply for a credit card. Apply for a car loan. Apply for a mortgage. That number often plays a role in whether you are approved and what interest rate you receive. This number is called your credit score. It is meant to estimate how likely someone is to repay borrowed money. Lenders use it as a quick way to evaluate risk before approving loans or extending credit. The concept sounds simple, but the details behind how credit scores are calculated can be a little confusing. So today we are going to walk through how credit scores actually work and what factors influence that number. Chapter 1: What a credit score is. A credit score is a numerical summary of a person's credit history. It is calculated using information from credit reports maintained by credit bureaus. These bureaus collect data about borrowing and repayment behavior. Examples include credit cards, loans, and payment history. The score is designed to help lenders quickly assess the likelihood that someone will repay borrowed funds. Higher scores generally indicate lower risk for lenders. Lower scores may signal a greater chance of missed payments or financial difficulty. Chapter 2: Credit reports and credit bureaus. Credit scores are based on credit reports. Credit reports are records that track how a person has used credit over time. In many countries, several major credit bureaus collect this information. These bureaus gather data from lenders such as banks, credit card companies, and loan providers. The information typically includes account balances, payment history, and the length of time accounts have been open. Credit scoring models analyze this data to generate a numerical score. Chapter 3: Payment history. One of the most important factors in most credit scoring models is payment history. This simply refers to whether bills and loans have been paid on time. If someone consistently makes payments when they're due, that behavior usually improves their credit score. Late payments, missed payments, or accounts sent to collections can lower the score. From a lender's perspective, past repayment behavior is one of the strongest indicators of future repayment behavior, which is why this factor tends to carry significant weight. Chapter 4: Credit utilization. Another important factor is credit utilization. This refers to how much of a person's available credit they are currently using. For example, imagine a credit card with a $10,000 limit. If the balance is $2,000, the utilization rate is 20%. Lower utilization ratios are generally viewed more favorably than higher ones. High balances relative to available credit may signal financial stress to lenders. Keeping utilization moderate often helps maintain a healthier credit score. Chapter 5: Length of credit history. Credit scoring models also consider how long someone has been using credit. Older accounts provide more historical data about borrowing behavior. A longer credit history can help scoring systems evaluate patterns over time. This does not mean someone must have decades of credit history to achieve a good score. But longer records often make it easier for lenders to assess reliability. Closing old accounts can sometimes shorten the visible credit history, which may slightly influence certain scoring models. Chapter 6: Types of credit. Credit scoring systems also look at the variety of credit accounts someone uses. For example, a person might have credit cards, auto loans, or a mortgage. This mix of credit types can provide additional information about borrowing behavior. Different forms of credit involve different repayment structures. Successfully managing several types may demonstrate responsible financial habits. However, this factor generally carries less weight than payment history or utilization. Chapter 7: New credit applications. Applying for new credit can also affect credit scores temporarily. When someone applies for a loan or credit card, the lender may request a credit report. This request is known as a credit inquiry. Multiple inquiries within a short period may signal that someone is seeking large amounts of credit quickly. Scoring systems sometimes interpret this as increased risk. As a result, several new applications within a short time frame may lower the score slightly for a period of time. Chapter 8: Why credit scores matter. Credit scores influence many financial decisions. Lenders often use them to determine whether to approve loans and what interest rates to offer. Higher scores may qualify borrowers for lower interest rates. Lower scores may result in higher borrowing costs or loan denials. Beyond loans, credit scores may also influence rental applications or certain financial services. Because of this, maintaining a healthy credit profile can have long-term financial benefits. Chapter 9: Improving and maintaining credit. Improving a credit score generally involves consistent financial habits over time. Paying bills on time remains one of the most important steps. Keeping credit balances moderate relative to available limits can also help. Avoiding unnecessary credit applications and maintaining older accounts can contribute to stability. While credit scores can change gradually, responsible borrowing behavior tends to improve them over the long term. To wrap up, credit scores are numerical summaries of a person's credit history used by lenders to evaluate borrowing risk. They are calculated using information from credit reports collected by credit bureaus. Key factors typically include payment history, credit utilization, length of credit history, types of credit, and recent credit applications. These scores help lenders make faster decisions about loans and interest rates. Maintaining consistent financial habits over time can help improve and stabilize credit scores. Credit scores may seem mysterious at first, but they are essentially a reflection of borrowing behavior over time. By understanding how the system works, people can make financial decisions that gradually strengthen their credit profile. While the number itself is simple, the habits behind it tend to matter much more. And those habits develop slowly through consistent financial choices. This has been a mini Leviathan production. If you enjoyed it, check out our other videos. Comment below what other topics you would like us to cover. See you in the next one.